Hey everyone, Pagaya Technologies reported second quarter results, which I will review in this video. I'm also going to update my recommendation for Pagaya stock. Coming into this report, I had the stock rated as a buy, so you're going to want to tune in to see if I'm changing that recommendation. So let's get started with the earnings results here. Total revenue grew by 8% to 195.6 million. The net loss attributable to shareholders of 31 million was a big improvement from the 175 million in the same quarter the prior year. It's good to see the company's making progress reducing the losses on the bottom line while it's growing revenue. And of course, being an AI stock, it's been interesting for many investors looking for ways to invest in the AI trend. Network volume grew to 1.96 billion, driven by growth of the company's personal loan business and new partners in auto and point of sale. Now, Pagaya is not the only company using AI in the financial industry, and it looks to be an interesting place to apply the technology. Legacy methods of looking at lending just with the FICO scores and credit scores seems outdated and seems like it could be addressed more effectively, although that remains to be seen because the technology is so new and we haven't seen how it performs during a recession or a steep economic downturn. Due to the better than expected results so far in the year, Pagaya raised its 2023 target for adjusted earnings before interest, taxes, depreciation, and amortization as a result of the positive results so far this year. Now, here's a key metric I wanted to highlight for you all that are interested in Pagaya stock, and that is the fee revenue minus production costs, right? So the company uh, generates loans and then sells it off, and in the process it makes fees, right? I like that business model because it's not tying up too much of its capital, keeping the loans on its books. It's just creating the loans and then selling them off and generating a fee in the process. So revenue from fees increased to 185 million, and the production costs increased to 120,613, and that left the company with 65 million in fees less production cost, an increase from the prior year. But more important than the absolute numbers are the margins. The margins are more important here because it demonstrates that it's growing in terms of the profit per loan made, per loan created and processed, and it's increasing effectiveness. It's getting better at doing what it does, and so this is really the metric to look at here. And the fees, revenue less production cost margin, the FRLPC margin, increased to 3.3%, up from 3% in the same quarter last year. So that's excellent. That's a critical metric that investors of this stock should watch every quarter as the company updates. And certainly, if you're watching my videos, I'll be updating this every quarter because this is a critical metric that demonstrates how good the company is in doing what it does, right? Generating loans, selling them off. How good is it at doing its core function? And in the most recent quarter, it improved. However, if you look back for the 6 months that ended June 30th, it actually decreased because the first quarter was much less in terms of the margin compared to the second quarter. So for the full year, it's at 3% in the 6 months so far, compared to 3.5% in the 6 months ended June 30th in 2022. So there is room to expand this further to get back to where it was at this point last year. So although it did improve in the second quarter, the first quarter was not very good in terms of this metric. So to update my recommendation of Pagaya stock, I'm still keeping the stock rated as a buy. I think it made good progress in the quarter. I think its business is in line with where the industry is trying to go to, right? The using AI in lending decisions could be a big improvement compared to legacy methods, and it can also increase the time, which the time to funding, which is a big friction point right now. You could think of some loans like a home loan takes so long to complete, and if you can apply these loans, now it's going to start with smaller scale, right? Personal loans, car loans, things like that, smaller scale, but if it works and it proves effective, it can be applied to a bigger scale like mortgages, which could open up a vast market opportunity here. So, for all those reasons, I'm keeping this stock rated as a buy. All right, thank you so much for watching, and I hope I'll see you again soon. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.